we can tell when founders are not focused on de-risking, on proving the main thing they need to prove. And that's almost always a mistake for them and for us. Like if you could find out with a day of work that your customer doesn't want this product and you didn't do it, why
Yeah.
not? And now is the pace at which founders can test things by coding faster with AI is just extraordinary. It's last time a founder said to me, I'm going to release a prototype. I don't even know when it was. When do you need a prototype for anymore? You can just build a real thing so fast.
Yeah. Got
But
it.
that
Yeah.
focused on the right risk.
Roy Bahat is the head of Bloomberg Beta, a venture capital firm that was the first to focus on the future of work and has a particular interest in the effect of AI on work. Bloomberg Beta has invested in Masterclass, Slack, Replit, Flexport, and LaunchDarkly, among many other startups. Bloomberg Beta prioritizes transparency with its manual living on GitHub and fosters trusted angel relationships by backing open angels, people like myself. And before Bloomberg, Roy started a venture-backed company, was a corporate executive at News Corp, in government at New York City's Hall, in media, and in academia. So I think it's safe to say, Roy, you've had a storied and wide-ranging career. How are you doing today?
There have been stories that makes it storied, and there's definitely been rage. I appreciate it. Like one of the reasons I appreciate this podcast is of all the roles that feel most comfortable with me, student is number one. So learning how to do this kind of thing together is still the journey I feel like I'm on.
Yeah, I think it's always amazing when you can work in a career or a field where you're kind of always learning or you have the ability to learn and sort of get paid either directly, oftentimes indirectly, but I think it's all kind of trending towards that goal of whatever you have in your career, right?
Yeah, I feel
So
that.
that's one of the reasons why I really enjoy the podcast is I like to tell myself I get paid to talk to people that I already want to talk to. I'm not really getting paid for this podcast, but let's call it indirectly.
Well,
So
but I mean, indirectly, the thing I'd say about that is, our firm focuses on investing in the future of work, as you know,
yeah.
and Zen. And, sometimes people ask me that, like, what percentage of all the jobs will AI automate? And I give the answer, which is 100%. The only question is when. And my evidence of that is if our great grandparents looked at what you and I are doing right now, like, that's
Yeah.
not work. They're talking about interesting stuff,
Yeah.
but whether we're getting paid for it directly or not, for sure we're working.
Well, I'm also going to say, I would say every single person in my immediate family has no idea what I do, how I make money. And
Our own daughter and son sometimes, but yes, I agree.
all right, cool. Well, I really wanted to have you on because number one, you guys just announced a big new fund. So I'm excited to dig into that. You and I have a working relationship. And then, we've been doing this podcast for a couple years now. So would love to get your take on the angel side of things and the earlier stage ecosystem. And I'm going to not spoil the whole fund announcement, but I think one of the cool things about your fund is that it's much, I would say on the bigger side for what I'm used to, but also you invest at the earlier stage. So why don't you give us the quick preview of the fund announcement you guys just made?
So the fund is a $75 million fund, which is our fifth fund. It is the same partners. It is the same fund size, and it is the same core investing strategy. Because as investors, we really believe in consistency, that you learn more. A difference in being an investor, I think, and being an operator or a builder is, operator builds it. What's the new thing for Q3?
Yeah.
An investor is much more, you were talking about your wife, who's a physician. It seems to me that the physician, before we start talking, the physician occupation seems to me analogous in some ways, in that it's much more about refinement. Like
Yeah.
and you might find a breakthrough new technique every so often, but you're just trying to carefully iterate. So, and I'll say our fund size is the biggest we can stomach, subject to being able to invest at day zero, because we love investing early. We love co-investing with angels. It always makes me crazy when I'm like, oh, the first investor in the company. They're like, no, there was an angel in there before you. It's like, great, but I would have loved to be first,
Yeah, I like that. So I want to talk about the day zero. And I guess it's funny. My wife is a doctor. She delivers babies. So yeah, you don't really want to reinvent the wheel there, right? You just want to deliver the babies and do a really good job. Keep it simple.
In that case.
Yeah, truly day zero. So you've got 5 funds at 75 million. And why? I think some people have asked you this in the past, but why not go bigger? Because I feel like I think it's human nature, right? To kind of want to do bigger and better. You mentioned that we want to be really good at the same thing. Do you ever feel like you might get a little bit bored doing the same thing over and over? Or do you think it's kind of your personality? What do you think about like a little bit more of the psychology of that same size fund over and over?
Awesome question. So first of all, I think that There's an economic incentive, which is many VCs like to get bigger because you make money based on how much money you manage. And
Yeah.
so, you know, you get big, there's sort of a Peter principle or whatever it's called, is you get bigger and bigger and bigger until you stop delivering returns.
Yeah.
In our case, I think for each of us, we're more motivated by a quest for excellence than we are
Mhm.
by the money per se. And I'd rather back founders who get better and better. And if that in order to do that successfully, we had to be bigger, then I would. And by the way, we did add a quote unquote opportunity fund, which is, as you know, there's a fund that can
Right.
invest at the later stages in the companies you've already backed, because we thought that to get the best founders, it was important to be able to have the capability to
Yeah.
follow them along the journey. But I think that's our psychology. It has not felt like a great strain. We often say, but it's only money. And, we are investing for financial return, but only because that's the vehicle toward excellence, not because any of us is like, look, I mean, I think the same is true for a lot of VCs. If you really just want to make money in your life, there are other ways to make money beyond investing in early stage startups.
Well, I guess not that I've been skeptical, but I would always say that, the 2% that a lot of, funds charge over 10 years, right? 20%, like you said, I don't think most VCs or some VCs would like admit that, hey, I'm doing bigger and bigger funds because I make more money guaranteed, right? That 2%. I mean, you don't need, 10 people to manage, if you're doing bigger checks, right?
And it's not just the 2%. It's also the returns, because you
Yeah.
get paid based on, if you have the same
But you did
percentage
say the bigger
return
the fund,
on a
lower the
bigger fund, you
returns,
make
right?
money. And we did a model once. So we have in the past invested in a venture firm itself, which is a
Yeah.
rare kind of investment. You invest not as an investor in the fund, but in the firm that runs multiple funds. And what we discovered in modeling that is the day you raise $1, even for a fund that triples in size, that day, 40% of the value, depending on a few assumptions, but based on our model, 40% of the value that you will receive as the fund manager is set the day you raise the money. Only 60% of it is based on your performance after the fact. So if that's true, raise
Yeah.
more money.
Well, and I also feel like, I know a lot of more experienced VCs like to say that, oh, we're not doing it for the fees. We do it more for the 20%, the carry, which I think is kind of BS. And then also too, I mean, what I've learned myself, and one of the reasons why I think you and I started chatting was I was doing a lot of angel investing myself. I said, wow, man, this is a long game. I've invested a lot of my own money. I thought I made enough money to do this. Maybe not. Maybe I need to do less. Maybe I need to do smaller check, because it really takes a long time. And I feel like now, it's even longer than it was in the past, right? To get exits. Like you've talked about, there aren't any of the smaller exits these days.
When I started doing this, I heard a fund takes 7 to 9 years. That was a Series
Yeah.
A. We often invest 2 to 4 years ahead of that, and now it's taken longer. So I think about our first fund companies: Flexport, Replit, Masterclass. I mean, those are just a few that launched darkly.
Yeah.
These are all companies where the value is still on the come. And
Yeah.
so it does take a really long time. And so in that sense, fees help. But, the part of it that I think is true is there's no VC who aspires to make their money through fees.
Mm,
You want to make your money by being a great investor.
got it. But it doesn't hurt to make
No.
your money.
And by the way, there are many, many VCs who've been around for a long time and never seen a carry check, meaning never made money on anything other than fees. And the reality is the fees get pretty big. I mean, you look at these firms with billions of dollars under management, somebody's taking that 2%, and a lot of times that's getting eaten by the guys on top.
Yeah. No, I've definitely done the math where, a lot of these smaller funds, if they've got three partners, let's say, and they start doing, a 50 million, a 75 and 100 million, and then they've got 3, 4, 5 funds, a few hundred million under management, right? And then they start stacking the funds, every couple years, you can pretty quickly, you're getting tens of millions of dollars and there's only, 10 employees. You can kind of do the math and sort of see that, it's pretty lucrative, I think, especially compared to a lot of other jobs, right?
That's right. And I mean, Fred Wilson, who's one of the great performing VCs, called it a get rich slow business. And I think that's accurate, is a lot of this stuff accumulates. I mean, in the sense that either of us could stop investing now and big checks might arrive in the future, depending on
Yeah.
how those companies do. So, but to be honest, I do it because I just love the mystery of it. And because I love builders, like supporting people. We think of founders as our customers, and supporting those founders just is my occupation. I love it.
Yeah, and I think that definitely comes through in a lot of the interviews that you do and from anyone who meets you and talks to you. So you mentioned a term that I want to dig into, day zero. Now,
Mhm.
literally, what does that mean?
Yeah. So the labels of rounds are one of the things that are always somebody's marketing. Pre-seed, seed, somebody's marketing to an LP, seed extension. Everybody's
You
marketing.
forgot one already, Roy.
Yeah.
Friends
Uh,
and family, right? Doesn't
Friends
that
and
come before
family,
free
angels.
seed?
Yeah, it's so funny, by the way, just to give you an example, is there's a company that we were the first VCs in. We might have
Yeah.
been the first investors in it. And then some other VC tweets when they had a big later stage announcement. The VC wasn't even at the firm at the time when they made it. It's like, we were so proud to have led their pre-seed. I was like, buddy,
Yeah.
I'm pretty sure I was on the cap table already
Yeah.
months before you did that. And he said, oh no, you led their angel round. And it's like, fine, it's all somebody's marketing. And he was mad.
Well, there's definitely, obviously, a lot of the, or not a lot, but definitely some of the VC game is sort of, because it takes so long to get returns, you kind of have to market yourself and say, hey, look how awesome I
think it's
am. Look
both
how
things.
well I'm doing, right? I invested in Lyft. Oh, did you invest, pre-seed, or did you invest in Series D? That's a big difference there, right?
Totally. So I think that you're right. And I think the reason for the marketing is even more profound than that, is that in VC, unlike most investor markets, the leverage in at least some companies is with the investee, not the investor. The investor is begging to get in, not like a public company where I can get into any public company if I'm willing to pay a price. And as a result, we all sell a commodity product. All of our product is money. It is legal tender for all debts, public and private. It is legally equivalent. And so what do? We bundle our money with services like helping and with the reputation that we have. So our brand. And so brand is an essential factor, I think, in VC success. And the reason we like the phrase day zero is it's factual. It's, you know what I mean when I say it, or at least if I explain it, you know what I mean. And what we're expressing is an aspiration to invest as early as possible. Now, then there are certain companies where it's like, I can't invest on this one based on just the concept. I need to see how this piece of it plays out. So we won't only invest at day zero, but we're willing to invest at day zero. And our best moments are when a founder hasn't even incorporated the company and we've agreed to invest, and they incorporate and form a bank account in order to take our money. Just because the earlier you get, the less it's just a financial transaction and the more it feels like part of the journey.
I think that was actually how you and I met. I think you might have invested in a founder day zero.
Totally. And by the way, the kind of relationship that we have, where we back you as an angel through our Open Angels program, is because we thought that it's better for the companies if angels like you can write bigger checks. And so we'd like to empower more of those people.
Definitely. And I'll ask you about my relationship with you in the Open Angel program in a bit. But so at this early stage, day zero, I guess logistically, this could be, like you said, before incorporation, before revenue, on that earlier side, as early. I like as early as day zero because that's sort of the goal, but obviously doesn't always play out. So maybe talk about, for example, like the last 2, 3 investments you made, what kind of stage of the company was it and the founder, and like what characteristics are you looking for at that stage, right? Because it's got to be a lot less revenue and a lot more relationship with the founder.
There is often no revenue.
Okay, no revenue.
Stage at which we invest.
Maybe no product.
Yeah, there is sometimes no product. And so let's see. I'm trying to think where to start.
So like the last few companies you've done, maybe you can speak about.
I just don't want to identify them if they are not willing to be known yet. But one of them was a post-revenue, beginning to scale startup that serves something in logistics.
Cool.
And in that market, while we heard great things about the founders, just looking into the founders' eyes probably wouldn't be enough in that case, because so much of the risk there. So the thing we think about is, what is the risk that the startup needs to prove it can overcome in order to build more value? And are we experts in judging that risk, at least to our own, do we have confidence in our own judgment? And so in that case, the startup at the concept stage had what I call alchemy risk. And alchemy risk is like, look, we're going to try a bunch of stuff and just hope that it works.
Yeah.
And as a result, I don't know how to bet on alchemy risk. I mean, I can do it if the price is right, which, where we have some belief in the founder based on the approach, but it's rare. I mean, we once invested in a startup doing personal AI, an AI model that was basically trained on your data in a particular way. And there we had to take alchemy risk. And so we changed it. Another thing that we've just agreed to do has some hard science risk. And so there we had to go based on the scientific reputation of the founder. And so I guess the point I'm making is, across different investments that are all early, based on the business approach of what they're doing and the risks involved, and I have a blog post on this that I call the thesis plan, which is a business plan where you say, here's what I'm going to do. The
Mhm.
thesis plan is, here's what I'm going to try to prove is right. And it really depends on the kind of startup.
Got it. So at the earlier stage, I feel like for me, a lot of the investment, kind of my investment decision is really based on the founder. And I mean, it's basically a bet on the founder, right? If it's pre-product, especially, even
For
if the
sure.
product is early and, even sometimes when they're starting to get revenue too, right? Because, the adage is, oh, you can kind of, if you've been in the industry, you sell to all your friends and family, all the people you know. But then the question is, how do you scale beyond that when you get to like the next round of revenue and sales? I mean, one of the things that I think about it similarly with risk, right? I sort of have a few different risks that I look at with each investment. One of them, I don't know what the best way to market this term, but I call it like I don't want the founder to run off with my money, right? Not necessarily fraud, but like that they're going to do a really bad job. And so a lot of
I mean, I think
times,
that, I don't know what to call that either, but we think stewardship.
like, do I trust them
Yeah.
basically?
So trust was the word I was going to use. So the trust isn't it. Trust is the general category. Stewardship is the subcategory. Trust is, do I believe that this person is going to do the things they say they're going to do? Do I think they have basic faith in their abilities? And stewardship is the particular aspect of that to me, which is, do they use the resources that they have responsibly?
Yeah.
And, I once had a founder who sent me his pitch deck and it showed him getting paid at the concept stage. I forgot what it was, but let's call it like it was 300,000 plus off a $1
Mhm.
million round. And I was like, buddy, that seems like a lot of money to use for you. And he's like, well, trust me, you're not going to regret,
Mm.
hiring me and I'm going to be worth the money. I was like, no, it's the other way around. You're the
Yeah.
owner. I'm investing in you and I work for you. And so your own stewardship with the money, I'm betting on that. You're not my employee. And so in that case, I don't think that was necessarily right or wrong. I don't think that was a bad or a good choice of the founder. I think it was just an incompatibility in our approach and theirs. And I think a lot of the way we invest, if I had to, by the way, we're public about our investment criteria. You can go on
Yeah.
our website. We aspire to be the most transparent VC. But if I had to boil it down into radically simplify it, which is hard,
Yeah.
there are a ton of things that are just gates. You have to pass this test. Do we trust you? Do we want to work for you? Do we think the deal terms are fair? There's lots and lots of those. Everything else with lots of pluses and minuses is, do I have one reason to think that I could tell if this was going to be one of the best companies ever? And if we have that, then everything else is a check the box.
Yeah, because I mean, early stage, you kind of have to go in with that optimistic lens, that optimistic viewpoint. Otherwise, everything sort of sounds pretty bad. Right? You can always find a lot of negatives at the early stage, right?
Yeah, that's right.
Especially if they're disrupting something. So, if you had to kind of boil it down to maybe the top two or three risks that you look at early, is it founder? Is it sector? I mean, the deal terms, I think I heard you say on another podcast that, if you're going for outsized returns, right, like it's hard to say no on price, right? So, how would you kind of rank maybe the
Mistake I've
top
made before.
two or three,
Yeah.
the top two or three founder?
Yes. The main reasons we tend to say no. So the top one is lack of focus. Is they think they're going to do two or three things. Everybody thinks they're focused because everybody's saying no to 97% of stuff.
Yeah.
But the difference is, are you saying no to 99%, 99.9%, 99.999%? And we just like really focused founders,
Got it.
or who know what they're going for and why, or willing to abandon it. How will you know if you were wrong? That kind of thing. So that number one issue tends to be that. Number two issue tends to be that the core bet that the founder thinks needs to be true in the next phase is just not one that we're not qualified to assess. Oh, you need to know if restaurants are going to buy this thing. Well, we have things that serve restaurants. When the demand side seemed clearer, I don't really know how restaurants think about what to buy. I
Yeah.
know some markets and not others. It's a kind of a lack of faith in our own judgment about whether or not there will be something there. Then I'd say there's just a host of issues that by the time we're talking to a founder, we've already vetted well enough. Like,
Yeah.
I've already vetted, am I generally understanding of the space? I've already vetted by the time I'm talking to a founder live. I've almost, not all, every time, but often done some or all of my backdoor references on that. Meaning I've already gone around with the people we have in common. And so at that point, I don't really know that there's a founder risk. The risk, it's not even a risk, is more incompatibility. is like, okay,
Yeah.
we're talking to them. It's like, I don't really want to talk to this person every day for the next, well, not usually not every day, but I don't want to be available to this person every day for the next 10 years, just because it won't be fun for me. It won't be rewarding. It won't be enjoyable. So those are some of the clusters of some of the issues.
I really like your second point that it has to be a space that you believe in or that you know well or that you know something, or you have to have some kind of intuition or feeling. Like you don't, there's all these stories, right? Oh, this company started this and they pivot. Okay, right. That you don't want to, that happens a lot, but I think it has to be something, maybe it's not the exact product, right? That is going to be, the $1 billion idea, but it's got to be some kind of general idea or space you believe
Yeah,
in.
I mean, I think you need to
I
have
like that.
enough expertise to trust your judgment. Because I mean, to me, the two core investor questions are: do I think this is going to be a great investment?
Hmm.
And I think this is going to be a great investment. And what I mean by that is one of them is about how you think the company will perform. Will it be one of the great? Does it have a shot? Invention? Be one of the greatest companies in the history of capitalism? That's the bar. But then the other one is, do I have the judgment about this company? Sort of why me? And when sometimes something gets to me and it looks like a great deal, but I'm like, man, if this were great, there's a lot of other people who understand this better than I do. That line about poker, if you don't know who the
Yeah.
pigeon is at the table, it's you. And so I believe in that. Now, at the same time, you can end up in groupthink, and very important to avoid that. So like, I'll give you two examples of different
Yeah.
companies. One is Replit, where we were the first VCs in the company. The first person was an angel, Christina Cacioppo from Vanta. And it was a space I had thought a lot about. A lot. It was an online IDE at the time. I'd been thinking about that space for years, been in touch with the founder for years. And so I had a lot of confidence in my own judgment. Might have been wrong, but I had a lot of confidence. And so we said yes. And a litmus test we apply is, if everything goes sideways right after we invest, will we still be confident? In this case, it wasn't that. It was that other investors were just wildly unenthusiastic. And I had enough confidence that I didn't care. I was like,
Yeah.
great, we'll convince them. Another example that's slightly different is there's a company we're in called A to B that is now pivoted into a space that we know less well. It sort of doesn't matter, why we know less well. But when we first invested, I really didn't like their original idea, but I liked the domain they were in, which is related to commuting. And I said, you know what? I really don't like their original idea, but these founders are so smart that either they're wrong and they'll figure it out, or I'm wrong and they'll figure it
Yeah.
out. Either way, they'll figure it out. And the lesson on that, just to share another story from somebody else, because I think these stories are really how we learn, is I remember Alfred Lin from Sequoia once told me his story about when he was an early stage investor previously in his career at a thing called Venture Frogs. And
I thought you were going to say venture fraud. Venture frogs. Okay, that's a better name.
but not fraud. They got pitched PayPal.
Yeah.
And Peter Thiel and Max Levchin were like, we're going to beam money with Palm Pilots. And Alfred was like, that seems silly. Why don't you just use email? No, Palm Pilots. And so Alfred passed. Was Alfred right or was he wrong? He was obviously wrong on the investment, but he was right on the substance of the choice. And so knowing when the founder knows better or may know better is one of these things that as an investor is so hard, but essential.
Yeah, and I also feel like I tell people a lot of the best startup ideas sound really stupid at the start. Otherwise, someone would have done it by now, right?
Facebook was one of 26 college social networks a year,
Interesting.
Yeah, the originality is wildly overrated.
So, what's one piece of advice you have for founders these days that you kind of, you see it as a mistake all the time, or it kind of bugs you, or you just think, in your years of experience, you want to impart that knowledge if you had to pick one thing?
So first of all, as you know, I don't know if I believe in advice because I mean, my thing on LinkedIn.
But you were a founder, so you have a little more credit.
Well, so I think I have empathy and I can share what did and didn't work for me, which I often do. But I'm not sure if I have prescriptions for people. So they're my customers. Like I remember I came out of a meeting once and James, my business partner, one of my two partners, along with Karen Klein, James Cham, said to me, hey, I feel like you really hit it off with that guy. I was like, I think we did. He's like, it seems like you might want him to work for you if you were like a CEO. I was like, exactly. He's like, wrong. You want to invest in the founders who you want to work for them. And it's like, okay, that's a shift in mentality. And so it makes advising a little tricky. But here's what that we can tell when founders are not focused on de-risking, on proving the main thing they need to prove. And that's almost always a mistake for them and for us. Like, why wouldn't you, if you could find out with a day of work that your customer doesn't want this product and you didn't do it, why not? And now the thing that's changed, even in the last 2 months, but certainly in the last year or two, is the pace at which founders can test things by coding faster with AI is just extraordinary. And so last time a founder said to me, I'm going to release a prototype. I don't even know when it was. It's like, prototype. When do you need a prototype for anymore? You can just build the real thing so fast.
Yeah, got
So
it.
it's that
Yeah.
focused on the right risks.
Yeah,
Risks.
I like that de-risking too, right? Sort of like when I'm looking at an investment, it's like, don't give me, try to de-risk as many things. Like you email me and say, hey, I know a ton about this space. I've done this. I've built it, right? It's like, oh, this guy, this person's guy or gal has already done this. They've already done that, right? And then there's, maybe one or two areas I still need to look at. But if I have 10 things, I'm like, oh my God, they got to solve 10 issues. It scares me a little bit. So,
It's like sequencing. It's sort of like, why are you
yeah.
raising money now instead of just knocking that out for a day and then raising money?
Yeah. So one of the things I noticed about your firm very early on is that I think you guys have had this future of work tagline, I think as long as I've known you and maybe even before.
We've been doing the same thing since we started.
Yeah. So do you feel that tagline is still relevant today? Do you feel angry that people have copied you and then not copied you and now people are talking AI? How do you think about that future of work tagline as it
Yeah.
applies to your
The thing I
fund?
say is it's more an area of focus. It's sort of like it will be relevant to me for as long as work can get better.
Yeah.
Can work get better? Sure can. Some people suffer from having not enough work. Some people suffer from having too much work. It can get better in 1,000 ways.
AI could
And
take a lot of jobs or not, and that's the future
in
of
that
work, right?
sense, it is as relevant today as it was.
Yeah.
As a phrase, it was frustrating because for a while people did it and kind of defined it narrowly as like when Slack became popular, which we were small
Mhm.
investors in at a later stage for accurate marketing, which we try to be accurate. Did Slack, it's sort of like future work was productivity tools, basically. It was what I call the future of working for us. But
Yeah.
to me, the future of work is so much broader. I mean, the rideshare companies, as you know, are future of work companies.
Right.
You know,
Economy.
Flexport is a shipping broker. I mean, it's so broad. And so I became a little annoyed that people assumed we were narrower than we were.
Mhm.
Really get annoyed when we get copied. That's fine. What I get annoyed with is when I struggle. I mean, honestly, it's a marketing game. And I think we're only okay as marketers, to be honest, our firm. And so I get annoyed that we haven't figured out how to be like seen as the OGs of the space as consistently as I would like to. So I'm not annoyed with them. I'm annoyed with me.
Mhm. Got it. And so you mentioned AI a couple times. I mean, how is that, I sort of building, sometimes I joke with every founder. It's like, you got to have AI somewhere in your pitch deck, right? These days.
Sort of like you need to
So-
borrow somewhere in your in your dishes, like if you're cooking. And so I don't think people should bolt it on for the sake of. We've been investors since 2014, a year after we started our firm. Somebody who worked for us came to me and to James, and she said, I really think we should be investors in AI. Siobhan Zillis, who was then on the formation board of OpenAI and is now at Neuralink. And I said, I think it's way too early. But our firm's culture is if you believe in it, you should do the work as
Yeah.
long as it's consistent with our values. She went and did research. She came back and found 2,000 AI startups. And the big insight was they weren't calling themselves AI startups because the phrase was out of favor. And so we even called it machine intelligence at the time. But we were talking about AI. We made our first generative AI investment in 2016, by the way. And so, you know, what I see now is just an acceleration. Acceleration isn't even the right word. I see a growth of 10 sizes of the capacities of what's possible. And I think I see every reason it should continue. It's like somebody asked us, are you guys over concentrated? It's like sort of like asking a biotech investor if they're overly concentrated in drugs. It's like, I don't know, isn't that the whole game right now? And so AI is truly helpful on some level in everything software and technology related. And so everything should include AI. Is AI its focus? Necessarily. I mean, we just invested in a company that helps with like it helps with something in the sales process. Barely using AI. I mean, at some point they will, but it's certainly not going to.
Yeah. And I listened to a couple of your interviews on Eric Newcomer's podcast and TBPN. And I think you sort of referenced this in that, like everything is kind of AI. If you're building a website or, if you're building a product, like everything kind of uses AI, sort of similar to like the term technology, right? Like, are you a tech company? Well, it kind of depends on your definition of tech, right? Like technology over the last 100, 200 years, is it computer or is it going from horse to cars, right? Like it's kind of a very broad term depending on how you look at it.
Yeah. And I think there are two aspects of that question. One is, what are they actually doing?
Mm.
And there, they should clearly be using AI in some ways. How much, how central, like that's a judgment call if they're overusing it or underusing it.
Mhm.
Building too much software is just as much of a sin as building not enough software.
Yeah.
That's the question of how they describe themselves. And that's a marketing question of,
Mm.
are they marketing themselves effectively to VCs? Well, if you're lying about putting in AI, that's bad. If you're leaving it out of your story entirely, that's probably also bad. And, how do you market yourself to talent? How do you market yourself to customers? And so it's the presentation of yourself to multiple audiences and the substance. And we think about both of them.
Yeah, very cool. Well, the last thing that I wanted to end on that I sort of forgot to ask earlier, but
Oh,
we got a
man.
little sidetracked. So it was a good discussion. Oh,
I'm not a
yeah.
founder.
Well, I'm a good interviewer too, because if you talk too much, I don't hesitate to interrupt you, but you're doing great so far, Roy. You're a professional. And I was curious, though, I think this sort of how Bloomberg Beta fits into the larger Bloomberg
Oh, yeah.
empire. Maybe you could just shed a little light on the Bloomberg empire, because I think everyone, knows Mike Bloomberg. They know Bloomberg, the media outlet. They know Bloomberg Terminals. I think I just saw a tweet that said something like Bloomberg Terminals makes $12 billion a year. I won't make you confirm or deny, but it seems like very profitable.
I've never seen the numbers. Mike gives the numbers private. First of all, I know Empire. I mean, Bloomberg at its core, the core
Mhm.
offering of Bloomberg LP, which is the company that Mike started decades ago. And by the way, seed strapping is now a popular phrase, which means
Mhm.
raise its ground and then get to profitability. He sort of seed strapped his own company because he took his severance payment,
Mhm.
put it into the company, and that was the only outside money. They had a customer deal where Merrill Lynch got a piece of the company, which he then eventually bought back. But the core offering is financial data and a set of services that allow people to use that data, including communicating with each other, transacting on trades, all in compliant ways, dot, dot, dot.
Yeah.
Attached to that is media, which also helps the securities industry, and services for other industries like government and law, et cetera.
And just to be clear, the media would be Bloomberg.com, the journalist that
Yeah.
write article.
Yeah, exactly. Business Week is was the acquired magazine, but now it's a
Mhm.
bigger brand than that. But it's Bloomberg.com. It's Bloomberg on television, on the radio. It's a wire service that goes out to other publications, et cetera. And the reason Bloomberg Beta exists is that Bloomberg, a little more than 10 years ago, 12 years ago now, 12 and a half, said, we want to understand the world of startups better. And therefore, we should invest in them. And at the time, I said, well, be careful because corporate VC is terrible. And you guys probably want to avoid that. I knew them because I'd worked with the Bloomberg folks in a past life. And to their credit, they said, okay, well, what would a way be of designing it that might work? And I said, well, if you focus on financial returns, then you can align your interests with not only the people who run the venture capital firm, but with the founders. And then you'll see the best quality startups, and then
Yeah.
will give you the market wisdom that you want. And so somebody at Bloomberg once described it as market research that might make us money. And I think that's a good way to look at it, is in lieu of a traditional market research approach, it is market intelligence about startups. And we don't share anything confidential back with Bloomberg.
Mhm.
Generally, there are only 4 people at Bloomberg even allowed to know what we invested in. If a Bloomberg journalist, by the way, reaches out to me and says, hey, can we see your list of companies? I'm like, yeah, go look at my website. And so we exist to provide them with that intelligence through the strategy of
Yeah.
investing in startups and facilitating relationships with those in Bloomberg.
Yeah. What might be one tangible example or scenario where there was some startup you invested in that later on ended up, some piece of insight or something that benefited some person or property? at Bloomberg?
Linear in the sense that, Bloomberg once bought a company that competed with a portfolio company. We didn't know what to do. We'd invested foolishly in their competitor. It didn't work in their competitor. But we knew a lot about the market space generally. And so even things like spotting that AI was important in 2015, Bloomberg, by the way, already had a group working on machine learning. Bloomberg had been early to this stuff, but emphasizing it, elevating it to senior leaders, connecting them early with the AI labs, that's from a particular investment. But if we weren't investors in great early stage startups, if we didn't know that Anthropic was really important when the day it split off from OpenAI, then I think we wouldn't have been able to help. And then the other thing I just say that's important about Bloomberg in general, this is not Bloomberg LP now, this is separate, but Mike's foundation, Bloomberg Philanthropies, which of course is funded in part by the profits that he gets from Bloomberg LP, does a lot of good for the world. And we're
Yeah.
really proud that we contribute to those profits.
Definitely. And I mean, is it sort of is there a formal opportunity for, you or someone on the team to present to, at a Bloomberg Day every year? Or I'm kind of curious if if it's sort of like people know.
Multi-level, it's what in enterprise that we call multi-level relationships. Of course, we have
Like people know they can call or
monthly-
text you if they've got a question.
a monthly memo from us. Mike gets briefed every so often. We circulate, once a year to a broader group of executives. I was just in our Toronto office and met with a bunch
Got
of
it.
engineers and journalists.
Definitely.
So it's sort of, and then there's often a lot of hack stuff. Hey, some group is looking at this technology. Who do you know?
Makes sense.
Some refer startup stuff. So it is a multi-level relationship. And the way I'd put it is other venture firms put a lot of time into managing fundraising from their LPs. We
Yeah.
put time into trying to serve the knowledge needs of our LP.
Yeah. I mean, well, I don't know. I was going to say it must be nice having one LP, but is it? I don't know. Is it better or worse to have
So
just one really big
funny.
LP?
I think the grass is always greener on the other side, although we love our LP and we've never sought to have new primary capital from other
Yeah.
LPs. We would work with other LPs on individual deals or companies,
Mhm.
but not for our fund as a whole, because Bloomberg's been great. And, the plus side is we only have one, and they're really deep on technology. They care much more. I mean, I remember I was once at LP Day for another firm, and one of their investors asked a question. I thought it was going to be about something about the technology, but instead it was about like the e-commerce company selling handbags. What kind of handbags? We talked about technology with Bloomberg folks all the time, and it's a deep technical company. The CEO, Vlad Kliachko, was the head of engineering, and at the same time, we have one. So if something goes
I mean,
wrong,
it's kind of it's the pretty standard business problem. It's great to have one customer. They really reliable. They're big or huge. You only have to have one relationship, but obviously it's risky if things, don't continue in that direction, right? So it's sort of
exactly. But I'll say, if it weren't Bloomberg, it would be hard for me to see it working. I mean, I was at News Group previously before being a founder.
It does seem like the perfect fit with the kind of business, the other, it's interesting to hear you describe all these other, sometimes I think people forget everything like the Bloomberg media empire you described. I'm like, oh yeah, I forgot. They've got, magazines. I'm like, wow, that in itself is large, the terminal, right? So there's sort of all those things going on, and there's probably a lot of opportunity for synergies and learning and formal and informal type stuff.
That's right. And Mike himself is a role model to founders. And in a role model to me, like just in the ethical integrity of what he's done, the business success, the giving back to the world, all of it. And so all those things all add up, and we're very proud of his example as an example for founders.
Very cool. And my final question before I let you go, apparently I'm listed here. I'm reviewing your manual. I'm listed here as part of the Open Angel program. So thank you for
That's the Open and Open Angel.
Yeah, that is the Open and Open Angel program. So can you give a quick spiel on that?
Yeah. So we realized relatively early on in the life of our firm that angels were undervalued in the ecosystem, that they were more helpful to founders. And we wanted to empower some angels so we could work with them more, be in dialogue like this one. And so we basically said, what if we took a small piece of our capital and we put it behind angel investors? It also has the benefit of diversifying our portfolio. Like you will see things and get in things that I couldn't see and get in.
Does this come from the $75 million fund?
Yeah, like all from the same fund, all one strategy. And then we write checks behind angel investors where, lots of VC firms have scouting programs. I would say there are two major differences between ours and other VC firms. One is the point of ours is not to source deals for us to invest in later. It is, we don't do things for ulterior motive. The point is, empower the angel, just do the thing. The second thing is a lot of other scouting programs, it's sort of like a bank account that the angel can draw on whenever they want. We are religious about alignment of interest. So as you know, when you invest $1, we invest X dollars behind that on a fixed ratio, because I want to know when you make money, I'll make money. And then I can fully trust that because our interests are aligned, you do what you need. As long as it's ethical, you support.
I actually don't really like scout programs because I feel like it's an extension of the firm or the fund, and you kind of have to get them to agree and buy on. And, then it's like a lot more work for something like checks.
Somebody would ask me, one of our open angels asked me if they should invest in something. I was like, I have no idea. I'd be making the investment.
Well, I can safely say I don't think I've ever asked you what I should or shouldn't invest in, but it is interesting. One of the reasons I wanted to have you on is because of the, that's kind of the whole point of me doing the podcast, is to see how other people are looking at these investments and then, kind of take all those data points and apply them to my own investing and strategy.
I love that. And I mean, honestly, I learned from the questions. So keep asking them. Next time I'm in LA, I would love to hang out in person.
Well, I do have a surprise for you. I should be in SF in about a month, so you will probably be getting an email or a call from.
Well, depending what it is, we spend some of the summer in Milwaukee, which is where I am now, which is where my wife is from. And I love being here. It gives me a different perspective. Nobody loves it. But if we can see each other in person, I'd love it one way or the other.
All right, sounds good. Roy, well, I really appreciate you coming on, talking about the new fund and giving us a ton of insights into the future of work, AI, and all of your experience as an investor and all of the awesome programs that Bloomberg's got under the
Well,
umbrella.
if
So,
only I can
uh,
emulate your media success. Folks follow me. I have something to learn too, and I'm grateful to be here, Harry. And it's been just a joy getting to work with you.
sounds good. Thank you, Roy.